There's no doubt that the growth outlook has improved over that time period. Growth pretty much across the board bottomed in Q3, Q4, depending on where you're looking at last year, and since then has gradually re-accelerated. Most notably, the US has clearly improved. The PMIs reinforce that, but even in places like Europe, where they're far more challenging outlook, we've seen growth improve from admittedly low levels. China's also bottomed. And I think the driving force behind that, I think in the main has been because you've had a very supportive backdrop in terms of central bank easing. Most notably, obviously, Bernanke, is very, very committed and very publicly committed to aggressive quantitative easing program that is very supportive, in our opinion, to risk assets. But secondly, Mario Draghi, the new European Central Bank governor, has come in and gave his very famous "we'll do whatever it takes" speech in the summer of last year, and that again has successfully contained the risks associated with Europe, and we've seen some confidence restored to markets and growth generally re-accelerate from a bottom last year. It's our opinion that equities are a very, very compelling value on any kind of medium-term view. And the main reason for that is if you look at the sort of long-term relationship between bonds and equities, equities look very, very cheap. In fact, the data that we have suggests that equities are fairly pretty much as cheap as they've been for the last 50 years on an earnings yield versus bond yield basis. And we think over time this really gives very significant support to equities. And I think the main mechanism for this arbitrage to be closed is really corporates. And they will in the first instance be buying back their own stock, which just mechanically would be very accretive to their earnings per share. Secondly, growing their dividends. And then I guess thirdly, M&A. We believe that the environment going forward is probably very, very supportive for mergers and acquisition. Again, this would be very accretive and again supportive to equities. So I think there's a lot of truth to the old analogy, don't fight the Fed, and to the extent that the quantitative easing is driving up the relative price of bonds and cash, we think equities remain a very compelling asset class. Of course, there are always risks to any view, and I think there's two main ones that we would focus on. One is to the extent that quantitative easing is a major supporter of equities. Clearly, a disruptive or early exit from quantitative easing would be a negative, and I think more specifically, a exit for the wrong reason, i.e. an exit for inflation rather than growth, would be a negative for markets. And to that extent, we'd monitor inflation expectations very closely. In particular, we're looking at a 2-year forward inflation expectations in the market. And Bernanke himself has talked about a threshold of approximately 2.5%. Whilst inflation expectations have crept up a little bit in the recent past, they still remain importantly below the 2.5% level, so we think they're contained. And if you look at any kind of longer term measure of inflation expectations, again, they remain very well anchored. So clearly a risk that we have to monitor, but we think contained at the moment. And then I guess the second risk that we'd point to is generally clearly the developed world generally has very high levels of fiscal debt, and to the extent that these involve quite difficult and challenging political debates and political decisions in terms of allocating scarce resources, I think that has to be monitored very carefully. And you've seen that obviously in the first instance in Europe, where they've got very, very difficult political decisions to make associated with their debt levels. But even in places like the US, you've seen very difficult debates around the debt ceiling, sequestration, and the approval of federal budgets. And again, we'd expect those debates to remain quite difficult for some time and be a marginal negative for growth going forward, and something we'd have to watch quite carefully. despite all these risks, we think equities remain compelling value on any kind of medium-term view. While clearly there are always going to be setbacks on, whether it's Cyprus or the Italian elections. Clearly it's a noisy macro environment, but we think despite this volatility, equities will continue to perform very well. And of course, we've talked about the risks. If any of these risks do transform into anything bigger, we have the ability to go into cash, and we certainly would use that. But based on what we know, we think equities remain the asset class of choice.